Okay, thanks for tuning in. This is the weekly S&P 500 chart storm walkthrough. So we're just going to go through the 10 charts and have a look at adding a little bit of extra context and comments around them further than the tweets themselves. Okay, so the first one here. S&P 500 is spending more and more time below that 50-day moving average. And I mean, really, there's hardly anything more to say than that. You look at it there, it's the more time it spends below that 50, the more tenuous things become. I mean, you could kind of draw a little set of downtrend lines here. I mean, the time frame I prefer to look at, drawing a trend line within a month is not really, probably doesn't carry that much weight. I mean, probably worth pointing out, though, at least in passing, is that were you to draw those trend lines there, what pattern you'd have there would be called a bullish flag. Now, we had a bullish flag set up there, broke out to the upside and set the way for a bit of an extra move higher. So, it could be that in the works, but either way, at the moment, spending more time below that 50, and so it does put things on a more tenuous footing. And speaking of 50-day moving average, what we've got here in this chart is the moving average breadth. So this is the number of stocks that are above their 50-day moving average. So the index itself is just below it, but the components, there's still 40% which are above their 50-day moving average. At this level, it's looking somewhat oversold. The cautionary then, of course, that if this is a turning point, it can easily get more oversold. Started to become oversold there, and then became more oversold early 2016. And you get a more powerful oversold signal if it gets to quite a bit lower than where it is right now. And so, speaking of breadth, this one is kind of about breadth as well. So what we've got here in the black line is equal weighted S&P 500 performance relative to the standard index. Now, this one would start trending down if more of the, smaller companies are underperforming against the larger companies. So, the larger companies tend to drive the index more than the smaller ones. So, if the larger ones are outperforming, or if they're all performing in line, then it shouldn't really be too much difference. But what it has done is created a bit of a divergence there, and that divergence doesn't necessarily have to close. But when one's going one way and the other's going the other way, there's two ways that can resolve. One is that the smaller ones start to go on a tear and start outperforming against the larger ones, and then the other way is that the large ones just start to come unstuck, and that would probably be the bearish side. That way it could fold out. So, and that one was on a See It Market article there, and so you can click through that link for a bit more context and a bit more explanation around that. Number 4 is from Eitan Metric, definitely worth following, it from LPL Financial, and he has put together a bit of analysis here on what happens during a government shutdown. Very relevant, of course, because there's a real prospect of that happening again this year. And the bottom line is that historically it's been a relative non-event. I guess, though, you put it into a bit of extra context that we've got now, like, valuations are very high, and, as I mentioned before, things are looking a little bit tenuous. So, it could be different this time, but even if you had like a 4.4% fall, which we had in the late 70s there, 4.4% down on top of, I think it's already about down sort of 1 or 2% at the moment, it takes you beyond that 5% down level, which which is something that we haven't had in quite a while now. So that's one to keep in the back of the mind. Number 5, this is Morningstar's measure of median stocks versus price versus fair value. So they have a methodology for assessing the fair value of a stock, and then they take the price versus the median versus the fair value. So you can see there that during that the pointy end of the correction in early 2016, it became very cheap, started to become quite expensive earlier this year, and has now started to become slightly cheap. Somebody mentioned in the comments before that this indicator started getting cheap just before the 07-08 crash, and yep, you can see there that it started to get cheap in the lead up to those dual corrections there. And when you're taking a signal from valuation, small deviations like that, like those ones, you don't really get that much of a signal from them, unless it's kind of adding to a broader case which is more fundamental driven. But when you're getting these very much deeper signals like the earlier 2016, then they tend to carry a bit more weight. So I guess the rule of thumb really is for valuation, the best signal comes from the more extreme readings. That one, I just included that on the moment, the Twitter moment. This is the moment view that on Twitter, because I replied to somebody about that. They wanted to see how that compared. So this is the 200-day equivalent of that 50-day chart that we saw before, and probably the same conclusions hold. Worth noting here that there's a bit of bearish divergence going on, which is kind of similar to what we saw in that other chart on equal weighted performance of the S&P 500. Now, as I mentioned here, the second half of this is going to be about charts from the top-down charts monthly chart. But if you're not following us over there on Twitter, make sure you do. Put a lot of charts on there, so definitely worth keeping on top of that one. And we've got a link there, so topdowncharts.com/monthly. If you want to have a check out that monthly chart book, go ahead and do so. So the first one is number 6, another view of valuation. So there's the absolute valuations, more traditional ones. So the red line, we've got forward PE, trailing PE, and the PE10. And they all give you slightly different sort of signals, but really the main message there is that it's pretty much elevated versus history across all measures. So, and I don't think that should come as too much of a surprise to anyone that valuations are increasingly higher. Still not as high as they got in that sort of exceptional period in 2000, but if things keep on going the way they do, then it could get up there. Certainly, the higher valuations go, the more difficult, or the higher the bar is for future, valuation multiple expansion-driven performance. And honing in on that P10 metric, this one shows American or USA versus pretty much the rest of the world here. So we've got developed markets excluding US, and emerging markets is a big gap there. And what that tells you is that there's ample relative value for global ex-US. And we've seen quite a bit of allocation switches by asset allocators, and certainly that's something that we've been of the view that makes a lot of sense. And speaking of valuation, sort of an accompanying chart to valuations here is the whole cash allocation aspect. And there's a lot of talk about the whole cash on the sidelines thing. Is there cash on the sidelines, is there not? And technically there is, because whether you look at the blue line on the right hand or the black line on the left hand, it's about 15-20% allocation to cash technically speaking, that could go to zero, right? And so, there is technically cash that could go and be deployed, but historically we're at the bottom end of the range on both metrics. The blue line, by the way, is just what's implied by ICI funds metrics. So, it's more of a market share metric, that one, but it does line up with what's reported in the AAII allocation survey. So, I think it's quite an informative chart, really. And, in many ways it does make sense to hold, less cash when interest rates are so low. But then again, as valuations rise, arguably the value of cash rises because, just that comment before that, the higher valuations go, the harder it is to generate future positive returns. And, valuations get too out of control, then the value of cash gets higher because when valuations come full circle, the market rolls over to bear market, or you get a sizable correction. That's when the value of cash becomes realised, because then you can go and buy back in at cheaper prices. And of course, aside from generating income, probably the most valuable function of cash is capital preservation, at least in nominal terms. S&P 500 earnings outlook. This chart really just comparing trailing EPS growth versus the SERI weekly leading growth indicator, and there's about a 52-week lead there, so it's pointing to at least a little bit more upside there before a moderation in the pace of growth. It's important to see when you see valuations at such high levels. It's important for earnings growth to come through to actually drive returns. If valuations have topped out, if you think about the drivers of stock market returns, it's really three core components. It's dividend yield, earnings growth, and valuation. And speaking of earnings, this is sort of a chart that uses earnings to look at profitability. And USA is in the black line there, and its return on equity. And you can see there that during that 2016 sort of micro recession, it fell quite substantially, and a fairly clear recovery is currently underway. And it's that improvement in the fundamentals that has been driving this recent rally. I mean, there's been a lot of other sort of factors that have been contributing to that. A bit of prospects of tax reform or stimulus that have yet to come through, but the things that are coming through right now is improvement in the fundamentals. And when you think about a market at a turning point, if you're seeing fundamentals rolling over as well, that would tend to add weight to the idea that we are at a turning point. But at this moment, doesn't really look like that. We can certainly see a big price correction, and if fundamentals hold up, then it'd be one of the old classic dips to buy. But in the meantime, waiting and watching price to see what the market's telling us, and watching fundamentals to see what the underlying trends are. And that is it for this S&P 500 chart storm walkthrough. If you like what you saw, then go ahead and follow on Twitter. Put this out every week. And if you like the video, go ahead and check out some of the other videos that we've done. I'll be putting another one out later in the week. And the easiest way to do that is to subscribe to the channel. You get, I think you get email updates whenever I put a video out.